Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing Constellation Brands stock, ticker STZ. The stock fell 17% today after they reported earnings. That doesn't show up on the fast graph. It won't come in until later tonight. The market just closed about 40 minutes ago as I record this video. So I thought this would be an interesting one to look at because we have quite a few alcohol and also kind of candy companies, I would say, like chocolate companies and candy companies that are all kind of falling and have kind of similar issues going on. And I think the strategy I'm planning on using with Constellation is going to be similar that I'll use on some of the other ones. So it's the one that's closest to a buy price right now, I think. And so we'll take a look at it here. As always, this is not individual investing advice. It's just how I analyze stocks. Okay, so we have the fast graph of Constellation here. I also think I have it ready in my spreadsheet. Just double check that real quick. And yeah, so first we'll look at the big picture, right? So this goes back 20 years. And we can see that they had pretty steady earnings through the Great Recession. And then but not super fast growth necessarily. And then they kind of took off about 10 years ago, 10 or 12 years ago. And have had kind of a burst of earnings and then kind of a flat period. And the last couple of years, earnings growth has been pretty good too. So let's zoom in on what we have going lately. Now, when I look at, so when I'm using the fast graph, it's great for looking at information and getting data pretty quickly, especially when you're sifting through stocks. But you don't want to get too rigid necessarily on the dates that you use. Kind of my standard that I go to lately has been 12 years after I look at the big picture. But what I see here is I have this period where they were growing really fast for 3 years. But since then, that trend has pretty much changed, right? Now, they had good growth the past couple of years, but we've also had, well, this missed a little bit, so that's not going to be quite as good. But we had inflation during this time period, and it's possible it just took them a little longer to pass that inflation on. So, if you assume like a couple year delay, then all these earnings growth years look pretty similar, I think, once inflation is considered. Because we didn't really have much inflation this is like really 2018 because this starts in February of 19. So 2018, 2019, right? And then leading into 2020. So what I like to do is when I notice something like that, I say, okay, let's just assume, usually I take the most conservative view. And so I'll shorten the fast graph to start in their 2019, which is really 2018. So this gives us a much more conservative, and then these forecasts are all going to come down after this last earnings report. So we can shorten that to this year as well. So this gives us a better idea of what's been going on. I mean, this is still 1, 2, 3, 4, 5, 6, 7. This is 7 full years, basically. That's not an insignificant amount of years. I mean, I like to have a recession. We have a little bit of one kind of with COVID. But I think this gives us a better idea of what their real earnings growth probably is. They also bought back, I didn't save the graph for this one, they bought back about 6% of shares outstanding during this time. So they've also boosted that would really affect these last couple of years the most, boosted the earnings per share growth a little bit. So we have a little bit of that going on. We do have 1 year where earnings fell slightly. So when we look at the fast graph, they have 6.67% earnings growth through this period. I think I have 5.45. So just slightly lower because of the things that I'm accounting for. But it's much slower, I'm guessing. Actually, let's do the 12. Let's just do kind of the standard one. So when I start off, a lot of times I'll start off with like 12 years. So that gives you a double the earnings growth rate that I'm actually using. If you just did that, didn't do anything else. So you always want to use some judgment, I think. Now the market, one of the reasons the stock dropped 17% more than where it's at right now on here is because the market got 2 pretty good growth years in a row, and it will start extrapolating that out into the future. So so this was trading at, we'll call it a 22 PE here, 24 just a year and a half ago. And that's kind of where it was, like a 24 PE, which when you think about it is really high for 5 or 6% earnings growth, right? It's maybe not so high if you're saying 11% earnings growth, which is what the market was thinking. This is why I try to be conservative and just kind of use, the basic numbers will help save you from doing things that are really stupid most of the time. But you do, in order to get those extra, percentage points of gains beyond the market, or not to make the same mistakes a market might make, you have to use judgment around the edges, right? So it's these little judgments that add up, and all of a sudden, instead of a PE of 22 being okay, not cheap or anything, but like not being crazy, well, if they're only growing 5% and they have a 22 PE, 5 or 6%, let's call that a PEG ratio of 3 to 4. Like that's really high. Like that's worth selling, right? So but it wasn't super exciting unlike some of these stocks. I mean, if you bought it back here when the PE was 26. So what's interesting, actually, I didn't look at this, but so the PE was 26 after 3 years of like mid 20% earnings growth. That's not like super crazy. What's super crazy is it maintained that PE ratio for another 6 years, right? Even though they didn't grow earnings that much. So sometimes people get into these stocks and they just hold them too long and they, stop thinking or something. And it can be hard to sell something if somebody bought this in 2012, and they're up a couple 100% or something, and then they have to pay taxes maybe if they sell. It's easy to make mistakes like that. But now the person that bought here is way underwater, and they could have sold, paid their taxes, and invested in something that actually went somewhere over the past decade. But the question now is, okay, where are we going to buy this? If we're going to. You probably already saw that I had a buy price on it. So now the first thing I'll note here is this 5.45% earnings growth rate is pretty low for me. Like this is like lower than I prefer, but it's not so low that I would not buy a stock. So the way I would think about this is more of like a mean reversion, kind of maybe a mild turnaround. I hate to call it a turnaround because I usually tell people I don't usually buy turnarounds. So I don't really feel this is like a turnaround. It's just the industry is having problems. We have these weight loss drugs that are coming out. We have just generally people don't drink as much as they used to. And so kind of all those kind of bigger kind of secular forces are going on. Not necessarily anything that the business is doing wrong, right? So it's not really a turnaround, but they can make adjustments perhaps as time goes on, whether it's cutting costs, coming up with new products. We don't know, M&A, whatever they decide they need to try to do. If that happens, then the stock and the earnings growth rises again, then the stock could revert to, a 20 PE or something like that, right? So that's more of what this type of investment is going to be. Even though you don't know the timing of it, if you can buy it at the right price, you can just kind of wait because it's probably not super risky as long as you buy it at the right price. If you pay 25 PE, then everything has to go really well for you to do well in the stock. So I have a couple different buy prices here. This one is just the basic valuation. But the problem with this is, so now we're getting into a point where this is actually my recession PE based on the 2020 recession, which is we'll call it a mild recession, because if I would have used 2008, this buy price would have been a lot lower. It got down to like an 8 PE back then. I'll show you on the fast graph here in a second. So I'm picking a pretty moderate recession scenario to look at for my recession PE. And what's happened is growth has gotten slow enough that the normal buy price is actually lower than the recession buy price. Well, using the 2020 recession. If I was using 2008, it'd probably still be lower. But as earnings maybe don't do as well, this number will get lower over time if earnings go down next year, maybe, right? This number will stay the same because this is based on this 2020 drawdown. So I used the peak earnings of $9.28 and the low price of, let's see, 116-ish. And I create a PE ratio out of that. So what I'm doing is I'm assuming they hit like 1360 this year, which I think is the midpoint of their new guidance. And then this would be peak earnings. So even if these earnings fell next year to $12 or something, the peak earnings would be the same, and we would be using those to and whatever the current price is to compare it to what it did back here. So that's the method. And then usually I add a little bit off the bottom of that too, because usually I'm not trying to I'm going to check to see if I did that or not on this one. So usually depending on what the PE is, the recession PE. Okay, so this recession PE is actually pretty high. So yeah, but I still adjusted it up like 30%. This might be something, sometimes I'll go after there's like negative news, if it actually looks really bad, and I can adjust this a little bit, and get closer to that 1124, because that's going to be the very bottom tick of the 2020 crash, right? So especially if I was using the 2008 one, you want to assume that it's going to perfectly fall exactly the same that it did in the past. You really just want to try to not buy it too high, like the people that bought in the past like couple years, or even the people that bought yesterday. You want it before the bad news comes. You want to be conservative enough that you're not buying something like this too soon. And there's never any guarantee. But this would be the same buy price that I've had on it, well, ever since I started looking forward to this year's earnings, probably last year. So I probably had the same price on it. I didn't lower it because of anything that's happened, other than it went from $13.70 for earnings this year to $13.60, so like 10 cents. So a couple bucks it might have gone down, the buy price that is. So 155.25 is the current buy price. That's about 15% lower than where the stock is trading right now. The stock's at 181.81 right now. So to get to the larger strategy here, if we take Constellation, we take like Hershey, a couple of the European alcohol makers, maybe even like a Brown-Forman. I'm just pulling some off the top of my head. These have all been hit pretty similarly for somewhat similar reasons. Fear of the weight loss drugs, general consumers already kind of pulling back on candy and booze. And so I'm going to probably end up using the same strategy here that I used with the rest of them. And that is, when it hits this kind of mild recession buy price, I'll probably take a small position, like a 0.5% portfolio position. And then what I'll want to see is if the price is still going down, I won't buy in a full position until the momentum is positive and coming out. Because if these consumer trends are longer term, they can be really damaging for the investor, even if they don't fall too much. Like even if you buy at 155 and the stock trades down to like 140 or something, it doesn't really get any lower than that, but it just kind of bounces around down there. That could happen for 2, 3, 4 years maybe, if the consumer's trend is kind of trending in the wrong direction just overall. So if the rest of the market and other businesses are doing better during that time, then you really have a big opportunity cost. Even if you end up with a small loss over 3 years, if the rest of the market is up 30%, I mean, that becomes bigger. So if you can not try to pick the bottom, I don't want to say like arrogance, but too aggressive, like trying to really like pick the bottom, then you just kind of pick a pretty good price where you think you're getting a fair deal if things turn around. And then what the momentum of the stock price will tell you is when the market's starting to really believe that usually earnings will be picking up and things like that, and they'll be doing better. So I use Seeking Alpha's momentum factor really, but a good one, the next best thing is like just the 200-day simple moving average, and anybody can look this up at their brokerage account, and this is up to date now, so, or almost looks like it's 3 pennies off of whatever Google's telling me. But so the simple moving average is like $247, but as time goes on, and if this goes any lower, this simple moving average will start coming down, and eventually, if the stock bottoms, it will cross that on the way up, and that's when it would be okay, as long as the price isn't too high. Like if we go back to 2020, I wouldn't have added again probably, because this is such a short spike. It was almost back up to normal by the time it crossed it. But on those long, drawn out recoveries that are definitely a potential, once you get into like that second year, then it starts to play, a better role in kind of guiding you on, okay, now that whatever adjustments they made to the business, whatever the secular growth or secular trend is, if it starts to reverse, when that happens, then the stock price will start to come up. And if the valuation's still good, you can add that full position. So I'd rather spread my bets around on the way down, take a little bit of Constellation if it hits, Hershey, again, 3 or 4 of the European alcohol and kind of candy makers. I'm tracking those too, and they're all looking pretty similar. So, maybe I'll have like 3% of the portfolio in these if they all hit on the way down, and then I'll just kind of chill for a while. If they recover, that's great. If they kind of hang out down there, I don't want to just keep buying all the way down. I really just want to wait to see what happens, because maybe the whole trend is stagnant or reverses slowly over time, and you don't want to get just stuck buying kind of dying businesses and have it drag on for like years and years, while maybe there's other businesses you could do well in. All right, hopefully that gives you kind of an overview of how I'm thinking about these. I gave you the price I'm looking for Constellation. I also have a weekly pick service over on Patreon for $25 a week. And if you have any requests, put them down in the comments. I'll get them on the chalkboard behind me. Eventually I'll make a video, and I'll see everybody later.